Welcome, everyone. I wrote an article just a couple weeks ago, and I decided to put this into a video format so that I could post it on YouTube and make it available to those of you who are interested in hearing it. The article really is about, I get asked all the time what I think is going to happen with the real estate market. I live in the Salt Lake City area. And so people are asking me about, hey, are we ready for a recession? Have we got a few more years? What about some of the other markets in the country? So it's obviously a topic that I think a lot of people are thinking about. And so I'm going to take a couple minutes today and just not give you any answers probably, but at least give you some things to think about as far as your real estate market and where it's headed. So there's a famous Kenny Rogers song that everyone is familiar with. You got to know when to hold them, know when to fold them, know when to walk away, and know when to run. I want to take a little time analyzing some of those questions as it relates to your real estate holdings. If you are either listening to or reading the script, there's a good chance that you're holding some form of real estate investment assets, or you're maybe looking to acquire some. There are a number of factors that are influencing the market today that may give the average investor cause for concern. Some of you may be incredibly excited about the current situation. Others may be tentative and not quite sure which direction to go. And others may be just plain scared. Although I'm not a doom and gloom guy myself, I've certainly been involved in real estate long enough to know that there are potential storm clouds on the horizon. Which again begs the question, should I buy more real estate? Or should I hold steady with what I have? Or should I sell and look for better opportunities? And if I decide to sell, what should I invest in next? Especially here in Utah, we've had unprecedented growth in our real estate over the last 8 to 12 years. Salt Lake City was one of the first markets to come out of the Great Recession that started in about 2007. By 2009, Salt Lake City was already starting to build new homes, and unemployment rate was already below 6%. And of course, housing prices were starting to rise. Some of that directly related to the ease of getting a subdivision started in Utah, as opposed to some of the more difficult markets to develop in, like California or even Denver. For example, the Denver market had started to come out of the recession close to the same time that Utah did. But the difference was Denver market had been somewhat constrained in being able to start building new homes, which caused inflation to rise faster. The reason is, in 2000, most of the country was in a mild recession that didn't affect Denver as much. Denver was one of those cities that drew a lot of companies that were involved in the dot-com craze. They liked the Denver market because they were startup companies that tried to stay away from the more expensive markets of California and gravitated to less expensive markets like Denver. They also liked an active lifestyle that could attract the talent that they were looking for in Denver. In 2001, when the dot-com bubble burst, Denver went into a real estate recession. A few months later, in conjunction with the dot-com bubble bursting and the deflation of the stock market, the Federal Reserve used the same playbook that they have used over and over again for the last 30 years to combat a recession, which was to lower interest rates. This caused many of the stronger markets in the country to have inflation, including Los Angeles, Phoenix, the Bay Area, Seattle, and Salt Lake City. But Denver remained mired in the recession. So 2004 or 5, we were sending all of our cash flow students to Denver because most of the other markets had too much appreciation. That meant that cap rates were lower in the other markets and no one was finding properties that would pay for themselves. At about that same time, Phoenix had 100% appreciation in 1 year, and the next year it was close to 60%. So if you bought a house for $100,000, next year it was worth close to $200,000. And the next year after that, it was worth about $320,000. After the crash, they dropped all the way down to about $60,000 for that same house. There were a number of markets like that, but Denver was leading the country in foreclosures at the time. We were finding 3-bedroom condos for around $30,000. and they could rent for about $800 a month. Those were major cash cows. Today, those same condos will sell for about $350,000. And that, of course, is a contrast between, at the time, a lot of the West Coast markets in Denver. Much of the West Coast was experiencing tremendous appreciation, and Denver was virtually flat. Because of the long period of real estate recession in Denver, many of the builders left the area or found something else to do. So the building market took longer to get started when real estate recovered. So the whole country crashed and every single market showed some form of downturn, including the usual solids like San Jose. The only market that had virtually no decline was San Francisco. And that's a unique market because it's virtually landlocked. The other market that made it through the recession with little downturn may have been Austin. Salt Lake City was one of the first markets to come out of the recession. It was one of the first markets that started building homes. And it was one of the strongest real estate markets in the country. We went through the recession as a state much better than many of the other states. As a state, Utah is much more conservative than most of the other states. And one of the reasons is that the state has always maintained a rainy day fund. So when the country went into a recession, instead of paying unemployment to all the out-of-work home builders, Utah decided to spend the rainy day money to rebuild the roads, thereby keeping the contractors working. In addition, fixing the roads, which needed to be done anyway, was done at a much cheaper price because of the out-of-work contractors were happy to do it for a cheaper price in order to keep working. Utah also benefited by the oil production in both eastern Utah as well as North Dakota. So both things combined to keep the unemployment rate fairly low in Utah compared to the rest of the country. So now you have a property or two that you own. Maybe you owned it before the recession and found a way to hold on to it through the crash. Maybe you saw the crash in 2008 and got into buying a house or two while they were priced pretty low. And today you're telling yourself, that was the smartest thing I ever did in my life. By the way, if your wife's sitting next to you, she wants to hear that marrying her was the smartest decision you ever made. But we tend to hold on to winners and we sell losers. When I was in college, one of my professors said, I can't tell you how to outsmart the stock market, but I can tell you that when your taxi cab driver or your hairdresser knows more about the stock market than your stockbroker, it's definitely time to get out of the market. So we find ourselves in those markets where assets are traded on some type of euphoria that basically suggests that real estate never crashes. That real estate has been so strong for so long that we're convinced that it's never going down. Those of us who've been around the block a time or two know that that's not the case. As a realtor, I was around literally before computers. When I started in '84, the MLS was a giant phone book sized book with all the listings, and it came out every 2 weeks. So I've been involved in several markets that have crashed. After college, I spent several years in California working with the Resolution Trust Corporation and other banks trying to unravel the real estate bust from '91 or so. What you learn after a while is that no markets are immune from a downturn. In fact, this quarter, the 5 worst markets in the country are all in the Bay Area, and that includes San Francisco. Those have been some of the strongest markets over the last 5 years or so. So here you are today, and some of you may have substantial appreciation in your properties. In some cases, $100,000 to $150,000 in appreciation in each of the homes that you own, and it's been your best performer in a long time. So now what do we do going forward? Well, the answer is going to depend on several things. I can't really advise you without going over your goals going forward. Some of you may have your property paid for. We're retired and living off the property and have no intention of selling it. Maybe it's across the street and we can keep an eye on it. There are a lot of reasons why someone would say, I want to continue to hold to this property. The other question is, should I sell it? And if I sell it, can I move it into something better? Maybe we should consider selling and doing a 1031 exchange. Maybe you're thinking about using a self-directed IRA or 401k where you can invest the money over and over again without using the 1031 exchange or constraints and still maintain your tax deferral. My assumption is that most of you reading this do not have your retirement funds at a level where you could retire today and are looking for a way to increase those funds. A rule of thumb that we use to determine where you're at with your retirement is that each of us has to have a monthly nut that we need to cover in order to pay our expenses through retirement. That can be anywhere from a couple thousand per month to well over 10,000 per month. Most of us will need somewhere around $5,000 a month just to pay our monthly nut or our monthly expenses. The rule of thumb is that for every $1,000 per month you need monthly, you'll need roughly $150,000 invested at about 8%. If you invest that $150,000 in Salt Lake City right now, cap rates, which are currently less than 6%, you'll need to find more than $150,000 just to get $1,000 a month of income. Most people will need equity of close to $500,000 to over $1 million. If you're holding on to this duplex or fourplex that you own, and maybe it's worth $300,000 or maybe $500,000, if you think the value of it is more than about $100,000 per unit, it's probably overvalued relative to its rental value. The rule of thumb is that you need to get 1% in monthly rent to justify the value of a property that's expected to cash flow. $100,000 per unit needs monthly rent of about $1,000 a month. That rent will give you a cap rate of roughly around 6%. Most of the duplexes and fourplexes I'm seeing listed right now are asking anywhere from $120,000 to some cases $200,000 per unit, and in most cases the rents are less than $800. In other words, if you purchased it at its current value and the collected rent would probably not cover the property expenses and the mortgage payment, let alone put any cash flow in your pocket. So if your property is worth close to $200,000 a unit and the cash flow value is less than $100,000, you can see that your value is tenuous. It's there because there's a euphoria right now as people are struggling to buy real estate and they may already be late getting to the party, so to speak. You need to look at the monthly rent that you're collecting and make sure that the value is in line with the rents. There's nothing wrong with selling your property for more than its cash flow value would suggest it's worth, but usually there's a limited time in the property cycle that people are willing to pay that much for the property. At some point, the value is likely to come down. Here's some observations on the Salt Lake City market. The House Price Index report currently suggests that Salt Lake metro market has an annual housing appreciation rate of almost 7%. The 5-year appreciation rate has been close to 10% per year over the last 5 years. Normal, by the way, is around 5%, so Salt Lake City has been well over the normal appreciation rate for at least 5 years and most likely since 2009. There are indicators that Salt Lake market may be overvalued. There's also some reasons why that may not be the case, but there are certainly some reasons for concern. One of the concerns is that the last quarter's appreciation rate and seeing how the market is currently doing in comparison with the last year and the last 5 years. The quarter came in at about 6%. Based on these three numbers, the trend for Salt Lake City is down over the last 5 years, but still above normal appreciation over the last quarter. Some of the possible concerns are that many of the highest appreciating and assumably strongest markets in the country over the last 5 years are now some of the worst in the country. The worst five markets in the country as of the third quarter House Price Index report are all in the Bay Area of California. And several of them, including San Francisco, are not only flat but are going down. The truth is, no market can stay strong forever. The other statistic that I look at, which is even more disconcerting, is an affordability index. For me, a very simple affordability index is how much money does the average person need to qualify for a $100,000 home mortgage? And the answer is about $25,000 per year. To maintain affordability, median income needs to be about 25% of median home prices. In Salt Lake City, the median home price is currently $392,000, but the median income is only $45,833. This means that the average person cannot afford the average home in Salt Lake City. On the western part of the country, there were only a handful of markets that were more unaffordable than Salt Lake City, and most of them are Seattle, the Bay Area markets, and most of them, by the way, are in declining status. In 2006, one of the predictors of the housing crisis was how many housing markets were considered very unaffordable. I've always believed that healthy appreciation is good for a market. But when the average person cannot afford the average home, that market cannot sustain its appreciation for very long. Some of the positives here in Salt Lake City market, static, which is normal unemployment rate, is about 6%. Utah's unemployment rate is currently 2.3% and has been below 6% for almost 10 years. The job creation here is very strong. Three functions I look at to provide for stability in a market are presence of large universities, state capitals, and high-tech jobs. And of course, Salt Lake City has all three. 8 years ago, I did a report for a syndication project, and we talked about all the high-tech employers that have or were planning on moving to the Salt Lake City area. There's a reason we call it the Silicon Slopes, because high-tech jobs are very plentiful. Sometimes we have national indicators that will signal a coming recession. One of those is what we call an inverted yield curve. Long-term interest rates are lower than short-term rates. This doesn't necessarily mean there's a crash ahead, but it does mean that those who trade bonds believe that there is some sort of a reduction in expected inflation in the future, and long-term rates are coming down. Unfortunately, when everyone believes there's going to be a correction, it's usually a self-fulfilling prophecy. So there's some concern about, when we see this inverted yield curve. The country as a whole is showing signs of housing prices declining or at least flattening, and that's not really the case in Salt Lake City. So back to the question of, should I buy, sell, or hold? We talked earlier about a situation where you have your retirement all covered and you're only looking to maintain your real estate cash flow income into the future. You may want to hold your properties and avoid the cost of trading. What about buy more? Is this the market you would want to buy more in? The fundamentals are, if you really love your property, you should hold it. But current cap rates make this market almost impossible to buy and hold for future cash flow. This is truly a value play market only. The problem with Salt Lake City markets is that rents have not kept up with the value of properties. When you bought several years ago, the project most likely cash flowed based upon your equity. Today your equity has gone up, but rents have not gone up as much. So you're earning a really poor return on your equity. And that may be okay if your property continues to go up in value, but by most matrices, we will only see modest increases in the future, if at all. So if you decide to keep the property, you'll have to live with the reduced cash flow per value. On the other hand, you could sell your duplex today that pays you about $200 a month and put it into an 8 or 10 unit in another market and probably get close to $1,000 a month or more. If you believe this market is going to continue to appreciate at close to the rate it has over the last few years, you may do better to keep it here. But if you're looking for cash flow to help you retire sooner, you may do best by investing in another market where cap rates are much higher. If you have any interest in exploring where you're at with your properties, and if you'd like to do something to get a better rate of return in the future, I've been doing these analysis with several students per month over the last 10 plus years. I would be happy to sit down with you for an hour or so. We can even do it over the phone if you'd like to. So feel free to contact me if you have any questions about anything in this article, or if you would like to discuss your situation with your real estate and see if there's something that you might be able to do to increase your rates of return a little bit. My name is, again, is Earl Klein. My phone number is 385-215-9501, or you can send me an email. Send it to summitrealestateretirement@gmail.com. Thanks very much for your time. Let me know if I can help you with anything.